Hello, everybody, and welcome to the monthly market memo for the month of February 2026. I'm Case Eichenberger, the Chief Investment Officer with RetirePath Advisors. And in today's short video, we wanted to walk through some of the leading events that shaped our markets for the month of February and so far for the year. And we have quite a bit to talk about, but first, let's just jump into what we saw for the returns for February, a little bit of a review here for our major markets of stocks and bonds. And what we notice is, what I notice is the everything basically outside the S&P 500 has continued to add value to diversified portfolios. Think small caps, mid caps, international stocks, even bonds had a really good February. And bonds did have a good February amidst all the stock market volatility that we've seen so far this year, which I'll get into here in a second with a couple slides. But so far for February, it was muted returns. S&P was down about 0.75%. But as you notice that those other markets that I mentioned, small and mid caps were up about 2.5%, and international stocks were up over 5% for the month alone. So just really good returns for other areas of the markets, which is finally good because the S&P 500 has really been leading for the very long time here, especially in growth stocks. So bonds were up 1.5, and cash was up about 0.25% in February. Now let's just look at year to date 2026, and you kind of see a similar theme, right? Mids and small caps are up over 7.5%, and international stocks are up over 11% to start the year in just 2 months. So just really good returns for a lot of markets outside the S&P 500, which of course we own as a lot of diversified portfolios that you may have here at RetirePath Advisors. So I really wanted to start this call and talk a little bit about what just happened over the weekend. I'm recording this on March 2nd. And to end the month, this kind of did come in the month. U.S. and Israel had a joint attack on Iran's nuclear infrastructure, which I'm sure you've seen in the news, destroying several sites and removing their leader. Markets today so far, as I'm recording this, are basically flat or in the green, depending on any given time. They opened up down quite a bit, down about 1%, and then moved higher. We'll have to see where we end the day, but so far it's been a lot better response out of the stock market so far than what maybe some of us would expect with a key joint attack on Iran. But we do believe if this does produce some more volatility, maybe downward pressure on stocks, that could be a good buying opportunity, as it really has been over history. What I'm showing here is a chart really from the beginning of stock markets in 1928 or so, all the way up to the last couple years, and you see just all these wars and conflicts that have occurred over time, and really the market maybe has a little volatility to start, but then moves higher. We look at GDP growth, we look at spending, we look at government, we look at earnings growth of the S&P 500, and all those improve over time. And that's what the stock market ultimately cares about. I think that's why you've seen some of this news be shrugged off so far, is that we still have really good pictures here in the United States and overseas for earnings of some of our bigger companies, and improved earnings for some overseas companies and the small and mid cap companies. So really, just an interesting end to the month, if you will, as the U.S. and Israel bombed Iran. But so far, not a lot of volatility in stocks, and any volatility could be a good buying opportunity there. So let me jump into a little bit of what I've been seeing over the last couple months, and I think you'll find this interesting. We've seen the last couple years, the leaders has become the laggards so far this year. And I think that's a good sign, and a good sign for a maturing bull market. We've seen value stocks, small and mid cap stocks, and overseas stocks all working in tandem in 2026 and in February. So I'm going to paint that picture here and just show you really last year's returns. You can see as it kind of cascades upward. You look at small caps and mid caps, didn't really do much, still positive 8% or so. And then value stocks had a good year, up 13, but everything else really was led by the S&P 500 up about 18, and growth stocks up over 22% for the year. But let's look at so far in 2026, and it kind of goes the other way, right? Growth stocks are maybe flat to negative a little bit. Same with the S&P. As I looked at this data, it was a little bit before the month ended, and it was still positive. But the point here is that some of these areas that have been lagging are now leading. Small and mid-cap companies are up over 8% and really have already outpaced what they did last year. And value stocks are beating growth stocks. And what I didn't put on this chart was international stocks, but you kind of saw that in the previous chart. So just really good returns for everything. This does help diversify portfolios, and we think this helps keep that bull market alive as it matures and looks to other areas that have been unloved and are now finally seeing some good returns. What have kind of been causing maybe the little, as I mentioned, the S&P 500 really hasn't gone too far this year, hasn't gone up much. And that kind of, I think, comes down to a couple reasons. And AI is a big part of it. A lot of these big companies, think Google, Microsoft, Meta, and a few others, have been spending gobs and gobs of billions of dollars. They've been spending a lot of money on AI and investing in AI infrastructure and data centers. Um, but the returns for them so far have been pretty scarce. We call them the hyperscalers. They've scaled up their spending, which has therefore reduced their free cash flow that us as investors really look for, and also reduced their share prices so far this year. So I want to paint that picture for you and just look at how the spending has really increased. The expected spending for this year and for the next couple years, you can just kind of see is around maybe 70 to 100 billion, but now we're up over five, six, potentially closer to $700 billion that they will be combined spending in the years to come. This, as we look at it, reduces their cash flow, and that's really what has been rewarding them in the past several years. That they've been cash heavy and asset light, and their cash flow to investors has been really big. But now they're going all in on AI, and you've seen really the stock market kind of start to keep them in check a little bit so far this year. And this has kind of dragged on the S&P 500 as Amazon is down about 8, Meta, Microsoft down 20, Oracle, which is another company that takes on more debt than the others to spend these dollars, is up down 37 for the last 6 months. The S&P, while is still up about 8.5%. So while they've kind of definitely reduced the returns you may have seen previously, the S&P 500 is still positive over the last 6 months, but so far this year, I think that's kind of weighed on the S&P 500. And then to kind of look towards the end of this presentation, we wanted to talk about software stocks a little bit because AI is a big disruptor. We know that it will be for years to come. And underneath the surface, some of these software companies that you may use in your current jobs or notice in the news a lot, like Salesforce, for example, is Adobe, Acrobat, PDFs is a good example. They've all come under pressure as people believe, and the market believes for now, that AI can really just take those margins that those companies have and reduce them down, and their share prices have come down as a reflection of that, and even potentially create new companies that can just do these types of works for a lot cheaper, which will, I think, benefit us all over time. But we've seen them come under pressure. Really, the software stocks and the Nasdaq usually track each other pretty closely. It's what I'm showing here on the left-hand side. But as you can see, the software, which is the dark blue line, has really just rolled over, and the Nasdaq has continued to move higher, maybe flat here to start the year. So software stocks have been under pressure. And why is that? It really is due to what I just mentioned, is the AI disruption. We looked at this on earnings calls, and you can see that they're just companies and CEOs are talking a lot about it. They're saying that it may be beneficial, but also disrupting their business. And that has been a lot of reason why you've seen share prices of these companies take a little bit of a dive. Again, a very small part of the S&P 500, but still some big names in there that AI is causing disruption underneath the market, while the market still sits close to all-time highs, if you will. And then the logical last question I think people ask is, what does this mean for jobs? Is AI going to take jobs? Is it going to end jobs? Well, so far we're really not seeing that. Now we'll have to keep this updated every month as I present to you. But so far, software jobs and job postings on third-party sites like Indeed are actually very much positive. This is the percent change from a year ago, and it's up over 12% year over year, while all job postings are actually a little bit flat or negative as kind of people have slowed down hiring. But software jobs are still very much in demand. That just goes to show you that while their share prices may be down, people are still hiring out there for software to try to get in on this AI craze that we've seen. So there's been a lot of volatility underneath the stock market so far this year. It's something I've been watching very closely, and we'll talk to you again about it next month. But so far, we've seen still very good returns. S&P 500 about flat on the year, maybe down a little bit, but a lot of other areas in your portfolio are doing very well. So we're happy to see that. And then lastly, I'll just talk really quickly about in mid 2026, we expect to see a new Fed chair as Jerome Powell will leave out his post, and then Kevin Warsh, the president's nominee that he's mentioned, will come in likely. Now, the market is still expecting two cuts this year, and I think that's kind of jostled around here, as you can see, is three cuts on the top and one cut on the bottom. But we've come around and really have come in at two cuts. And that's where the Fed expects it. That's where most other markets expect. So we're still expecting a cut maybe at that June meeting and towards the end of the year for to set up a really good monetary policy that can continue to, I believe, keep this bull market alive and well. So with that, I'll end there and thank you for your time to view this video. We approach the management of your complete financial landscape very seriously as a trusted steward, advocate, and confidant, completely committed to you, the client. Of course, please reach out to us with any questions. You can call me directly, email me. Of course, we have all of our websites listed here below and email listed as well. So thanks again for watching. I look forward to talking to you again in about a month and hope you're having a great start to 2026. Thank you.